What's up, everyone? Welcome back to the DeFi Podcast, episode number 4. Lots of action in the news, lots of volatility in the global economy. Russia has invaded the Ukraine. Inflation is now completely out of control. January of 2022, 7.5% inflation rate, actually, 7.5%. The Canadian government has also essentially declared martial law on the truckers' protest, and the Chinese real estate market continues to slowly implode. Needless to say, there's a lot of investor uncertainty right now. The markets are plummeting. David, where do you want to get started here first? What do you want to touch on?
I guess we'll just take it from the top.
Sure. So, as you know, Russia just invaded the Ukraine. It was initially labeled an entering. Now it has been labeled an official invasion. War has been declared. Where do you see this heading, and what effect on the crypto markets do you see this taking over the short and the long term?
Well, I was reading today, I think the Russian stock market lost like 259 billion in total value, like overnight. I don't know what that compares to in terms of their total stock market, but I know like the cost of insuring Russian debt is through the roof to insure against default and things like that. Yeah, their currency is crashing hard, so it's really not a good situation over there for them, for those in the country at least. Not forget about like internationally, but I mean, if anyone has cash, I say U.S. cash, it could be a potential buying opportunity now and then as we continue to see this evolve. For people that have cash on the side, this could be a nice entry point into the markets.
Absolutely.
Crypto or otherwise.
Well, we see Cardano down to 87 cents as of right now. Ethereum's down to 2,600. So over the short term, let's say the next month or two, do you anticipate the markets to continue plummeting? How much further do you think they'll go? Have we bottomed out yet? Where do you kind of see us bottoming out? And what is your long-term expectation for crypto? Like, how long do you expect it to take for things to start moving back in the right direction?
I think we're seeing a lot of like emotion in these markets, and emotion and rationality in financial markets don't really go together. So whenever you see heightened emotions like we're seeing now, whether around these international tensions, you should always be on the lookout for times like now where maybe it's worth buying. So I did actually buy some Cardano, enough in fact actually to take the pool over 150,000 pledged.
Mm-hmm.
So
I just adjusted the pool cert. Yeah. Claimed our rewards. We just hit our 2 additional blocks, so we're at 3 lifetime blocks total right now. So things are moving in the right direction with the pool. Absolutely. So sorry, I cut you off, just to get back to it. So over the short term, you see a lot of people being emotional right now. You see there kind of being a sell-off, but of course, we still believe long-term in the outlook of cryptocurrency. We do believe that crypto is the future of finance and financial products. How long do you think it will take for things to start moving in the right direction again? Do you think it will be months, years, weeks?
I mean, it really depends on how this situation unfolds. Mm-hmm. But I mean, it's just really too hard to say. I mean, long term in crypto means anywhere from like 3 to 5 years, maybe. Mm-hmm. So over longer time periods like that, incidents like these tend to not be as significant.
Mm-hmm. Absolutely.
And like people, I'm not sure if people just don't really think about it too much, but when prices drop, risk is actually lower. So
definitely
when stocks or crypto or whatever your investment vehicle is in the red, deep in the red. As long as the fundamentals are there, the risk in the investment is actually substantially lower. So buying Cardano, let's say at 80 cents versus buying Cardano at $3.20 or something is like the all-time high.
Mm-hmm.
Assuming a few things, like the risk in one scenario is 75% less than the other, since it's like basically the same underlying asset. So
and just building off that, that's exactly why I feel that having a long-term vision with investing, not just investing in something for a short-term gain, like a penny stock, thinking that you're going to pump and dump, or getting into some type of altcoin that you might not necessarily believe in for the long term, but you believe in the short term. I almost never invest in anything that I do not believe over the long term. That's why right now we see our fund buying Cardano, we're buying Ethereum. We're buying products or investing in products that even if they were to drop 50 or 60% overnight, we wouldn't panic sell. We would see, as you said, the risk is decreasing and that crypto is now on sale. So it's sort of a psychological factor that goes along with that as well. Kind of seeing your favorite cryptos go down, seeing them on sale, seeing that as a buying opportunity rather than a time to panic. So was there anything else that you wanted to touch on in terms of that topic, David?
yeah, so in the shorter term, I obviously would never recommend holding cash long term, because obviously inflation is going to eat away at your purchasing power.
Mm-hmm.
But in the short term, you need some stable coins or cash to be able to take advantage of opportunities like this. Because it's times like, I kind of think about it in like a Hansel and Gretel type of way. So like if you're buying today, you're kind of leaving a trail of breadcrumbs behind you, and then in 3 to 5 years, when we're in a new market cycle, you'll be able to realize the gains of those breadcrumbs you left for yourself a few years ago. So whether you're buying and holding crypto, or you're entering like liquidity positions, or you're lending, I think about it as like leaving breadcrumbs for myself for future me.
So it's almost like these short-term factors they don't really matter as much. I mean, there's a lot of stuff to keep an eye on with this invasion in Ukraine, this war in Europe, with Evergrande's continued implosion and the default on Chinese debt, the inflation. There's a lot of different factors to keep an eye on. But over the long term, we do still believe in the products that we're investing in. It's not like there's any kind of time to panic, because over the next 3 to 5 years, as you said, the market cycle changes. We believe that these investments that we're making now, these breadcrumbs that we're leaving, are going to grow into something much more fruitful down the line. So just changing the topic a little bit, I want to talk about inflation specifically. Startling statistic came out recently in December that 80% of all US dollars ever printed were printed in the last 22 months. Where do you see this heading? Because just in January, it was reported that 7.5% inflation in just the month of January 2022. And years ago, I mean, in the last decade, 7.5% inflation would be bad for the year. So having that happen in 1 month is very startling.
Oh no, I'm sure that's annualized. Like the monthly inflation is annualized to 7.5%.
Are you sure about that?
I'm almost positive.
Okay. Well, I do know that 80% of all US dollars were printed in the last 22 months. Either way, there's a crisis of hyperinflation going on right now. How do you see this affecting? I mean, obviously the price of goods and services are going up. How do you see this affecting investor sentiment and uncertainty in the markets?
So inflation, unfortunately, inflation raises the price of assets. So if you have assets, if you have assets, it can help hedge against inflation. Unfortunately, though, those on the lower end of the socioeconomic ladder don't have assets. So, I mean, it just kind of plays into some of the like socioeconomic issues that we're maybe seeing in this country, I guess, like in kind of heightening tensions between like these socioeconomic groups.
Absolutely. And just going back and fact checking my prior statement, you're right, David, 7.5% is the annual inflation rate. But we do see that climbing rapidly. We don't really see any kind of correction in the inflation rate going up so high. We're printing a lot of dollars. And furthermore, these stimulus checks that were being sent out last year and the year before, the bill was only like 20% of the money printed were actually going into these checks being sent to individuals. The other 70 or 80% were being taken by larger corporations, special interest groups, corporate donors to these politicians that passed these bills. So we see a lot of this sort of political corruption taking place in the United States and elsewhere, and it's really affecting legislation around cryptocurrency and legislation around the monetary policy of the US government. So building off that again, I want to talk about Evergrande and how last week they had $150 million of their assets frozen by the Chinese government over missed construction payments, i.e. people would put in their deposit, were promised homes by Evergrande by a certain date, and then ultimately Evergrande failed to deliver on their promises. And I also want to talk a little bit about how that goes in context of these ghost cities that we see in China. There's a ton of empty homes, while at the same time, there's a bunch of people who were promised that they would have homes built for them, and that promise has been failed to be delivered on. So it's sort of a weird dichotomy there, where there's too many houses, but at the same time, there's people who are putting in deposits for houses that aren't able to get them. So also going back 6 months ago when Evergrande began to default on $300 billion worth of debt, and BlackRock and some other US financial institutions admitted to having pretty significant exposure to these. Where do you see this inflation headed, and how do you think it will affect the crypto markets overall?
So in the longer term, I see crypto doing well against inflation. That's kind of why it was brought about in the first place. In Bitcoin's Genesis block, I believe it says something about the banks are crashing, and essentially Bitcoin is, at least in some part, the answer. So when I say it's the answer, I'm talking about the supply components. So unlike fiat money, which can be printed and printed forever, there's a fixed supply of Bitcoins out there. So you know for certain that when you have one Bitcoin, millions and millions of new Bitcoins can't just be created and dilute you out of your position, essentially. So in that regard, I see crypto as a hedge against inflation. But in the context of China and Evergrande, I know they also, China is carrying out, they have a high-speed rail network that they're building, which is also hundreds of billions of dollars into these ghost cities that don't have people in them. So there's also the kind of difficulties of, do you privatize the rail system that was supposed to be like a public transit type thing, and have affordable transport for, I believe the rail is mostly on the east and southern side of China. But basically the problem is, if they privatize these rails, companies will only buy the profitable routes, leaving the unprofitable routes to the government, and there isn't demand for these routes. And so there's kind of, they spent all this money on high-speed rail and building out infrastructure, but there's no people. So how do you get a return on your investment, or how do you kind of rectify this financial situation without greatly impacting the international financial system?
Well, it's like these governments have completely over leveraged themselves, and it's now seems to be starting to catch up with them. So it's a real problem. And I wanted to ask you about the concept when people say, when you hear somebody say taxation, or excuse me, inflation is taxation, do you believe that statement to be true? And how does that actually function? Like when money is printed, how does it affect or negatively affect the economic state of that country or that currency?
Well, so there's like a few things going on right now. So there's talk of inflation, prices are increasing, but we're seeing corporations are posting record profits while simultaneously raising prices. So I kind of see that as a conflict, because if you have record earnings, the need to increase prices, I don't think is there. But yet it's prices are also increasing at higher than the rates of inflation as well. So there's kind of some, I don't know, funny business going on there.
Right, and government is also as plain as day in manipulating the inflation statistics, so that way they don't need to pay out more in terms of like cost of living increases for Social Security and these other government programs. They don't need to increase the funding to them, so they are in ways manipulating those statistics. So we were talking about BlackRock a minute ago and how they had exposure to Evergrande. Now, we have an index fund that is SEC registered. We have 60% expected annual returns. We had 403% returns last year, really blew that expectation away. What distinguishes us from some of these larger funds like a BlackRock, like a Fidelity? Why would you want to invest in us or in addition to some of these more traditional investment professionals?
So some of these big banks have a history of scandals and kind of they've done things kind of behind the scenes that I would say maybe most people are unaware of. So we don't have that kind of history. So from that perspective, our hands are clean. But from the investment side, like you're not going to find the level of crypto exposure that we have in a traditional financial vehicle or like a BlackRock. So, I mean, even within the crypto space, I think we're pretty cutting edge in that, like we're bringing these financial tools to like everybody. So
let's expand on that a little bit. So we have three primary products. We have the DeFi Growth Fund, which is a custodial solution where somebody would just send a check, wire us funds, and then that would be invested in the growth fund, 20% performance fee, 2% management fee. And then we have our DeFi Earn program. Again, another custodial solution. But then we also have MBX Stake Pool, which sort of stands out in terms of our products because it is a non-custodial approach. Investors get to retain access to their funds at all times when they're invested in us. They can always put more in, take it out. So David, would you mind expanding a little bit about kind of our three big products and how they function, how they work differently depending on your experience level in cryptocurrency?
So I think the simplest and most straightforward product is the DeFi Earn. And so basically with DeFi Earn, what you can do is you can earn interest on a variety of cryptocurrencies or USD and kind of pick at a loan term basically that you would like. So you can choose a flexible term loan, which basically means you can deposit or withdraw whenever you'd like to, or you can choose to gain a higher interest rate in exchange for committing to giving us your funds for anywhere from 1 to 4 years. And then the interest rates fluctuate. And you can kind of check that out on our website. But that's kind of the most straightforward, where you put some kind of asset in, you get a fixed rate, and then when the term is up, you get your principal plus interest back. But the fund, basically, we're trying to create crypto exposure in a traditional vehicle that we think a lot of people that do invest in the stock market and maybe the bond markets would be more comfortable interacting with. So for people that don't have the crypto background, they can still get exposure to the index that we manage. And then on top of the index, we also generate extra yield by either like our stake pool or sort of some of the DeFi stuff that we do to generate interest.
So that's important to note, is that something significant that we're doing is we're not only like buying and holding the cryptocurrency, we are participating in the inflationary mechanisms of those assets. So with Cardano, we're running our own stake pool. So that's a way that we're leveraging the Cardano that we own for additional yield, which it could range from a 5% to a 7% additional yield, depending on the amount of blocks that we're producing. And with Ethereum, things like participating in validators, participating in decentralized protocols, different ways that we're leveraging our capital on top of just buying and holding cryptocurrency simply. So that's an important thing to note. How do you get started with us, David? How do you, if somebody is listening to this and wanted to get started investing in the growth fund or want to get started with the stake pool, where would they go and what would they do?
Yeah, so on my website, actually, if you go in the top right corner, there's a create account and there's a stake option. So the create account option takes you to our
DeFiStrategies.com, right?
Yes. So if you go to DeFiStrategies.com, in the top right corner, you'll see an option to create an account. And so that'll take you to our investor portal, which the investor portal is where we handle the DeFi earn and the fund, the DeFi growth fund through. And then the other button in the top right is a stake button, and that'll show you, that'll kind of direct you how to stake to our stake pool. For staking can be more complicated, especially for users that are maybe less crypto inclined. So feel free to reach out to Jack or myself on our websites to get in contact, and we'll walk you through the process of either acquiring Cardano so you can stake it to our pool, or helping you get it off of the exchange that it may be on so that you can have the full benefits of your cryptocurrency.
One thing that I wanted to note about that too is about exchanges and where would we rank the best exchange? What is the best place to actually acquire Cardano or any cryptocurrency from? Now, a lot of people start off by using Coinbase because it's really user-friendly, but the fees are astronomical on Coinbase. They're significantly higher than any other platform. You can use platforms like Coinbase Pro, which has reduced fees, but we recommend Bittrex. So I want to have you expand on that a little bit, David. Why do you like Bittrex so much? Why does it stand out to you beyond an exchange like Binance, like Coinbase, like Crypto.com? How does Bittrex kind of set itself apart from the crowd?
So their customer service is far superior to anything you would encounter with Coinbase. We also use Bitstamp, is one that I've been using actually since my early days in 2017. But we also recently got a business Kraken account after dealing with their compliance department for 11 months.
Persistence is key.
Yeah, so Kraken was one of the ones I've been on since like 2017. That might have been where I bought my first Bitcoins through, but
good. So Bittrex or Kraken, or I mean, what would you say your top three are?
So depending on the volume you're looking to trade, so I would say in terms of volume, Kraken has the highest liquidity, followed by Bitstamp and then Bittrex. Mm-hmm. Bitstamp's fees used to be highly competitive, but they did add a new minimum fee tier, so I would kind of be weary because I think they charge you like, it might be 0.5% for your first like 10,000 a month, which is kind of steep. Like competitive rates for fees are generally 0.25 or 0.2% or less of your trading volume. And so that tends to decrease as your volumes increase. But if you're a smaller volume trader or just doing this for yourself, just be aware of whatever the lowest volume tiers, because that's probably the fees you're going to be paying.
Coinbase is bad though. You don't want to. Coinbase Pro is fine, but Coinbase in and of itself, the fees are so astronomical. If you were to buy Cardano through traditional Coinbase and then stake it, it'd probably take you 9 to 12 months to actually earn your interest back from the amount of fees that you paid for buying the Cardano in Coinbase, then transferring it out to a Daedalus or a Yori wallet. So definitely steer clear of the traditional Coinbase app. So just shifting gears a little bit here, I want to talk about the blockades in Canada, the Canadian truckers blockading bridges and overpasses in response to the Canadian government's vaccine mandate for entrance to the US, which obviously affects truckers pretty significantly because that's their whole livelihood, is traveling internationally to deliver payloads. So Justin Trudeau invoked a law recently that was passed in 1988 that has never been used before, which deemed the protests illegal. They have frozen the bank accounts of the protesters and anybody who is sending financial support to these protesters. They're attempting to freeze crypto wallets successfully in some places when the wallet has been used by an exchange or is run by an exchange. So I want to talk specifically about the truckers, but also more so about the importance of getting your cryptocurrency out of an exchange and into your own ledger wallet, a wallet where you have your own seed phrase. David, why is it so important? Can you talk about some of the key differences between holding your crypto in an exchange versus holding it in your own ledger?
Yeah, so if you have crypto on an exchange or like a PayPal, you have exposure financially to cryptocurrencies, but you're not receiving any of the benefits of the cryptocurrency. So financially, you can get some of the ups and downs, but you don't get the tangible, the reasons that I'm in crypto isn't necessarily entirely because of the price potential or the investment potential, but also because, believe it or not, there is actual technology that goes into these things that I believe is investable. So, sorry, I lost my train of thought. What was I? Where are we going?
Well, we're talking about some of the key differences between holding your crypto in an exchange and holding one in a ledger, and specifically about how the Canadian government has they've ordered some exchanges to freeze the wallets of some of these protesters. And in terms of when they reach out to an exchange, the exchange may comply with that because it's not actually the crypto belongs to the exchange. Technically, it doesn't belong to the individual. Whereas if it's in a ledger wallet or something that's just a wallet overlay rather than it being in an exchange, then that crypto is protected. You cannot freeze that wallet. So kind of building off that.
Yeah, so there's a wallet, there's a software developer called Nunchuck, and they produce a Bitcoin wallet. I think they're Canadian based, but essentially the Canadian courts approached this wallet and said that they had to freeze the assets of everybody using the app. But unfortunately for the Canadian government, this Nunchuck and many other wallets are self-custodial, meaning they're not. So Nunchuck, the company, isn't a financial intermediary. They're simply a software company. So Nunchuck doesn't have custody of these assets. The individual who owns the wallet has these assets. So all you need to do to create a wallet with Nunchuck is you put your email address in and you make an account. And so, but my point is that it's not possible to have your assets frozen as long as you are the custodian of your own crypto assets. So that means that you have access to the private key. You're not leaving your coins on an exchange. You're not using like a Celsius, Nexo, Binance, Kraken, Coinbase, like the list goes on. But you're not using services like those where,
or if you are, you're pulling your crypto out of it and putting it into that wallet immediately. So these wallet developers, it's sort of, they're just developing a software that is kind of built on top of a node, and the user is running their own node. They have their own payment address. They have their own keys. So the company that developed that software, they have no control over the wallets that were created using their software. They only have control over the overlay, basically what goes on top of the node that people can use to, send and receive transactions, create new wallets, etc. Versus with an exchange, that is the exchange's node. That is the exchange's payment address. So they do have the capacity to freeze those funds. So let me see here. Where were we? I think we covered the truckers protests pretty well. That's another factor that's sort of affecting the global markets, causing some market uncertainty. So instead of backing down and taking a rain check on the mandates, they're doubling down and just going for it. So let's see, we want to talk a little bit about the stake pool and how we had our first snapshot is completed. Second snapshot is taking place today. Talk to me a little bit about what's going on with the stake pool, David, and what these snapshots are doing for us.
Yeah, so with the snapshot, so in Cardano, when you stake your Cardano into a pool, it takes anywhere from 6 to 10 days or 2 epochs, up to 2 epochs for your Cardano to start generating rewards. So our pool has the same process for paying out our governance token. So the Cardano that you had in our pool in epoch 322, in epoch 324, you'll start to receive your governance token. So when we've taken a snapshot, what that means is we've recorded the balances of all our delegators at a certain point in time, and then we're going to process this information and then pay out these MBX tokens in epoch 324, 4 through 22. Just like the Cardano blockchain itself. So some epochs, there might be a block reward with governance tokens. Sometimes there might be only governance tokens. But hopefully as we grow, we'll see more and more epochs where there's both rewards and tokens.
Absolutely. And I want to talk a little bit more about what these snapshots are doing exactly. So we are tracking every wallet that is delegated to our stake pool. And every week we're taking a snapshot at the same time every week or every epoch to determine how much active stake that wallet has with our pool. And depending on the amount of active stake they have, then we are tracking the amount of token that is due to each delegator. And they can cash in on their tokens at any time. I want to talk a little bit about how that process works. So you go to mainblockchain.com/claim. You submit a form to us, and then you also send 3 Cardano to a wallet address. Once we confirm that Cardano has been received, we will send you back your Cardano minus the minimum transaction fee with your governance tokens on top of that. So right now it's a manual process. I'm taking care of everything from my end, but in the future, we're looking to build some more automated scripts that will complete this process automatically rather than having to do it manually. And David, could you talk, I know we've talked in previous videos and podcasts about this topic in particular, but why did we decide to carry out this process manually at first and then try to work towards some automation rather than using a third-party resource like a DripDropz to distribute our token?
So we wanted users to be able to claim their tokens whenever it was convenient for them. So we didn't want the obligation to have to claim your tokens every 5 days or risk losing access to them. So if you're staking with us for 6, 12, 24 months and you either didn't claim your tokens or didn't even know there were tokens, at any point you can reach out and gain access to your governance tokens that you've earned. So that's one piece. But the second piece is that we wanted to think about how to minimize congestion on the Cardano network, as well as making a more affordable option than DripDropz for our delegators. So The logic was maybe instead of claiming your tokens every epoch, you could claim them every 6 epochs, which would be about a month. You could claim them once a year. So
whenever you want to, there's no time limit for people. They can just let them accumulate.
Instead of paying DripDropz almost 2 ADA every epoch to claim your tokens, you can, the minimum transaction fee on Cardano is like 0.18 maybe right now. So
it's low.
You could spend 0.18 every epoch. You could do 0.18 once a month. So my point is, not only are we minimizing transactions on the network by not forcing every delegator to claim every epoch, but we're also making a more affordable option that's kind of at our delegators' disposal.
Absolutely, and that's important to note that we're not taking an additional fee on top like DripDropz does. All we're doing, the reason that we need you to send that 3 Cardano is so that we can calculate and take the minimum transaction fee, which again is about, right now it's about 0.18 Cardano. So that way we can send your 3 ADA minus the minimum transaction fee back to you alongside your governance token on top of that. So all really important things to note. Now, just shifting gears again here, we want to talk a little bit about Bitcoin, Ethereum, and Cardano, and talk a little bit about the differences between those networks. David, do you want to kick it off with some key differences or similarities between those networks and how they sort of built off one another?
Yeah, so you've got Bitcoin, which has been around for over a decade at this point. Proof of work blockchain, more limited transactions per second maybe than others. Bitcoin doesn't have smart contract functionality, so it's more of like a cash, basically. Like you transact with it, and that's kind of maybe the full extent of it. So then you've got Ethereum, which has similar properties, although it doesn't necessarily have a hard cap like Bitcoin does. So the longer term supply is maybe less solidified. Although the short-term inflation rates are known and I would say decently understood. Ethereum also does have smart contracts, so you can do like simple financial things, or even we're starting to see more complex financial tools starting to be developed on Ethereum. But basically, I like to think of Ethereum as kind of like an arcade game almost. Like you put in a coin or some gas in Ethereum's case, and then it does something, and then if you want to do it again, you put in another quarter or whatever, basically. So I like to think of it that way. So you can do some pretty neat financial things on Ethereum. Unfortunately, though, like the gas fees have been pretty expensive.
It's a barrier to entry there.
Yeah, and so then that kind of paves the way, I guess, for ADA, because Cardano, unlike Ethereum, Ethereum has an auction-based fee system. So if you want to get into the next block, you can just pay more. So basically, confirming your transaction quickly basically goes to the highest bidder. But on Cardano, I believe it's more of like a first come, first serve, and the transaction fee is based on a fixed fee plus a multiplier of the size of your transaction. So there is no, like, the difference in philosophy, I guess, between Ethereum is Cardano, like space on the Cardano blockchain, I guess, is almost more of like a public good, where it's no, it's definitely rival, where it's like, it's designed to be less excludable, I guess, than maybe Ethereum is in terms of like the, like I'm trying to think of the like tragedy of the commons type scenario, and like the like I guess the economic differences between having an auction-based fee schedule versus like a fixed fee system. So there's kind of two major differences there between Ethereum and Cardano. We're starting to see some development for smart contracts on Cardano, so that's very nice to see. But then Cardano and Bitcoin also share some functionality in terms of the way that like your balances are determined. So Ethereum, which is designed with JavaScript, uses an account and balance model, which is inherently less secure than something like Bitcoin or Cardano have implemented. So I'm curious to see how this extended UTXO model plays into the smart contracts that are on Cardano, and if we'll see potentially a better DeFi experience with more security and less exploits and hacks on Cardano maybe than what we're seeing on Ethereum.
Yeah, and kind of going off of that, Ethereum, with Ethereum 2.0, when do you see that happening? Because they've repeatedly pushed it off, and we only see, I believe it's right around or under 10% of the total Ethereum in circulation that are staked in a validator right now. Whereas if you look at Cardano, it's night and day. Cardano has 73%, last time I checked, of the total supply of ADA is delegated to a stake pool. So I think that's one key difference to kind of point out, that Ethereum has a much lower percentage of their total supply in validators securing the network versus Cardano, which has a much higher percentage, and inherently that makes the network more secure. Do you think that is one of the factors holding back Ethereum from moving full proof of stake or moving to the full merger? What do you think are some key kind of hangups that that is causing the network to not transition over to 2.0 entirely?
I mean, a lot of it's just development. Like, is it secure enough yet, and is it developed enough yet where it can be used securely? Like, there's billions and billions, hundreds of billions of dollars tied up in Ethereum. But I think Vitalik has mentioned that at least all of the features that encompass Ethereum 2, he doesn't anticipate being ready for another like 4 to 6 years. So I'm not sure. Does that mean your Ethereum is going to have to be locked in a validator for the next 6 years? Is anyone's guess at this point. But committing to staking Ethereum is a massive, massive commitment, because it's illiquid for the most part. So
you don't know when you're going to be able to withdraw.
You don't know when you're going to be able to take out your currency.
Well, that's also a problem with when the 2.0 merger comes around. A lot of people are bullish that the price is going to explode, but I mean, you have to also keep in mind that these funds are now going to be unlocked, and investors are going to be able to finally unload their Ethereum once 2.0 comes around. So that may cause some negative price pressure in addition to the positive sentiment that goes into the 2.0 merger finally going through. Now, correct me if I'm wrong, but I don't believe the Ethereum roadmap has any push towards complete governance and autonomy, whereas Cardano does. The Voltaire upgrade, which is the 5th step of the Cardano roadmap, the 3rd step is what we're on right now with smart contracts, is to basically DAOify the entire network and kind of push it out of the foundation's hands and put it into the hands of the people actually investing in the blockchain. So I want to talk a little bit about that and sort of the decentralization aspect of Cardano versus Ethereum.
Yeah, so I'm not entirely sure what the Ethereum Foundation intends to do long-term in terms of its role in Ethereum, but I think that if they intend to have a strong oversight that kind of cuts into the whole decentralization vision, or it kind of undermines the whole process. So at some point, I would hope at least there's a transition, kind of like Cardano, to a DAO, where the consensus of the network and kind of the development and parameters are determined completely on chain by the chain.
How much more decentralized is Cardano versus Ethereum? Is it significant?
I'm not sure exactly, but I know that just like Binance owns a substantial chunk of the Cardano that is staked, Kraken owns a substantial chunk of the Ethereum that is staked. Somewhere between 9 and 11%, and maybe more at this point. Like, I know they had about 9 point something percent, and they acquired a company that had like 2 point something%. So I'm not sure where they sit right now in terms of their total ownership. When I say ownership, I mean like custody.
Mm-hmm.
Like I'm not sure what percentage of the Beacon chain is in their custody, but it's substantial.
And with Cardano, we have seen more of a push recently with the SundaeSwap ISO and the reverse ISO from some of these more centralized places like a Binance, like an ADA Lite. We see people kind of moving from the multi-poolers more towards the single pool operators because of these projects. So that's a really positive thing to see, that more funds, more Cardano is starting to be delegated or staked with SPOs rather than the multi-poolers. So that's a positive trend. Hopefully that continues. Now, just sort of finalizing.
Wait, one quick thing. So
sure.
I'm actually looking at ADA pools right now, and I'm seeing that single pool operators control 25.5% of the network, which I think is probably the highest I've seen in months.
I thought it was still 20. Last time I checked, it was 20, but before that, I'd seen it at like 16 or 17%.
Yeah.
So that's a really awesome trend to see. And what happened was initially with the initial SundaeSwap ISO, a lot of people switched to just these few SundaeSwap pools, which caused centralization in the single pool operator community. So now with this reverse ISO, what they're trying to do is have people now take their or redelegate their funds from the SundaeSwap pools and sort of spread that that delegation, spread that stake throughout the SPO community more evenly. So that's another really positive thing and a really positive trend. We like to see the market share of SPOs increase as much as possible. And just kind of finalizing what we were talking about between like the differences between Bitcoin, Ethereum, and ADA. This is commonly referred to Bitcoin being the first generation crypto, Ethereum being the second generation, and ADA being the third generation. Bitcoin, of course, the original, more or less just a simple store of value, decentralized money. You can buy it, sell it, trade it. But that's pretty much the end of the line, what you can do with Bitcoin, with a few exceptions. What Ethereum did is they not only created a decentralized money, they created a decentralized financial platform that people could build smart contracts and dApps on top of. So when you buy Ethereum, it's not like Bitcoin where you just hold it in a wallet and hope the price goes up. You can use that Ethereum, like you said, as a vending machine or an arcade game. You can leverage that capital and participate in multiple projects on chain. You can participate in the inflationary mechanism through staking. You can participate in smart contracts, yield farming. There's a million different ways that you can use Ethereum. So if you're just holding Ethereum in a wallet and not doing anything with it, I should really look into some different ways that you can leverage that capital. And the same thing goes with Cardano. Don't just hold it in an exchange. Definitely don't use Binance Earn or stake it through an exchange. Get it out of there. Get in a Yori or a Daedalus wallet, and stake it with a SPO. So that's sort of my message with as far as Cardano goes, and I guess the key differences between Bitcoin, Ethereum, and ADA. And I guess one last thing about that, the way that ADA is trying to separate themselves from Ethereum, from the second generation cryptos, is by being more efficient, more scalable, and more decentralized. And I think so far they've done a really good job of achieving those goals or working towards them. We are seeing some network congestion right now. But that's the next step in the roadmap. We're at step 3. Step 4 is Basho, and Basho is the scalability. So we know that the devs are on this, trying to work on some of these congestion issues. And once those are solved, and once we see more of these smart contracts, for lack of a better term, ported over from, or some of these bridges built for some of the smart contracts to be moved over from Ethereum to Cardano, I think that we could really see some explosive growth in the blockchain. Would you agree with that, David?
Yeah, I would agree with that, Stephen.
Okay, well, I think we're sort of wrapping things up here. Did you have any questions for me? I know usually I'm the one asking the questions, sort of interviewing you. Was there anything you wanted to ask me before we take off for the day?
I didn't necessarily have any questions for you, but I did want to mention one more thing about inflation before we went. So, inflation. So I guess a quick history lesson. So 1971, the United States goes off the gold standard. Nixon takes the U.S. off the gold standard. The U.S. dollar immediately falls 50% over the following 6 years. And I believe at this point is when the petrodollar was instated. And what the petrodollar is, this means that any country, petrodollars, I believe, means that all OPEC countries, or OPEC countries are oil producing something countries, but they're basically in the Middle East. Nixon was able, or the U.S. was able to get these oil-producing countries to denominate all of their bills in dollars. So that kind of stabilized the dollar for some time. But as we got into the 80s, we started to see inflation really ramping up to about a peak of 15% ish or so in 1980. And so today we're talking about numbers around 7.5%. But the key difference is that if you actually used the same methodologies to measure inflation that we used in the 1980s, we're actually well above the 15% threshold. So it's misleading to change the definition of inflation over a 40-year period and then compare today's data against data that's 40 years old, having two different methodologies. It's kind of like you can't compare them. So I follow some people on the internet that post data using the previous methodologies. So if we were to measure inflation the same way that we used to measure it, so when inflation was at its peak in the 80s, we'd actually be at, 15.5, 15, 16% inflation. And that's general inflation. So you might see more inflation in the housing market. You might see more inflation in the housing market. Maybe you'll see less in the food prices. But essentially, not only does inflation impact individuals differently based on their individual and their personal consumer basket, but we're seeing inflation numbers being understated and depressed, which makes it extremely difficult for just normal people like us to kind of plan and kind of know how to adjust our standard of living and our budgeting to maintain the actual standard of living. Because if we don't actually know what inflation is, we don't know how to account and kind of change our behaviors appropriately to match the actual financial climate. So I mentioned there were a few changes. So some of the changes there's a list of changes that have gone into the CPI since the 80s. But so one of them is homeowners equivalent rent. So Jack, you recently became a homeowner. But instead of using your actual mortgage payments to calculate inflation, which would make sense because that's the actual cost that you're incurring, they use a metric called homeowners equivalent rent, which is how much rent you would charge yourself if you were to rent your house to yourself. So that doesn't really make any sense. But it's an artificial way to depress the actual cost of shelter. So something else that's done in the CPI that's new-ish. So the CPI used to be an arithmetic CPI, which means like when you take the average, you add everything up and divide it by the number of numbers. That's like the average that we're all familiar with. But they switched to a chain-weighted CPI, and what that means is instead of taking an arithmetic mean, they now take a geometric mean. And for those of you that aren't as mathematically inclined as myself, a geometric mean is always going to be less than the arithmetic mean of a sequence of numbers. So it's another way to kind of depress the actual inflation rates. But yeah, we can kind of.
There's a lot of manipulation. It seems like a lot of government manipulation to try to like artificially depress the annual levels of inflation?
Because like the Fed tries to target 2%. If 2% isn't sustainable, then how do you have to like redefine 2% in order to get the numbers to operate. Like if the Fed's trying to target a 2% inflation rate.
Your audio just got really weird, David. It gave me a weird like. Regardless, I think. Did you have any final thoughts on that?
No. Inflation's high.
Well, stay vigilant, everyone. Appreciate you tuning in. We'll talk to you next week. Thanks for watching. Bye-bye.